All right, good morning, friends. So there are two things that we're going to talk about today, and it is the death cross and the golden cross. So the death cross is where you have the 50 period moving average drop below the 200 period moving average, and that is a strong bearish signal. Now, currently, we have a couple of sectors. Oh, and because we want to know, like, is the market generally reversing, or are we going to continue in this distribution phase where our underlyings are starting to come back to their volume point of control, and they're starting to come back to those demand areas, and the price of the underlyings are starting to become more, let's say, more fair value, or what the market believes is more fair value. So XLK, the tech sector, one of the growth sectors or main growth sector, we are seeing now that the 20 has dropped below the 50, and it is heading down towards the 200 moving average. It hasn't crossed, so this is not a sell signal, but this would be more of a neutral signal. Like, you wouldn't necessarily, if you're dollar cost averaging, you might not necessarily want to buy at this point, because it does mean that there's likely some downside momentum, because now the momentum is showing bearishness. And to really get the 20 period moving average up above the 50 and to continue an action where you start like back here, where you see the 20 really above the 50, really above the 200 in that trend, upward trend movement, we don't need to see more than one significant bullish day, but we would need to see a couple. And even if we have a bit of consolidation, that will actually pull both the 20 and the 50 closer to the 200. So right now, XLK is giving us a neutral signal. XLY, consumer discretionary, another favorite, is also doing the same. The 20 is now below the 50 and headed down towards the 200. So it's not a sell signal, but it's definitely a neutral signal regarding movement. XLV, healthcare, which is also tends to be a growth sector because they require a lot of research and development for their, to be able to borrow money. So a high inflationary environment is difficult for those biotech sectors. So you can see that the 50 has now just crossed over, the 20 has now just crossed over the 50, and they're both headed down towards the 200. So again, that is neutral. And then XLC, communications, that is strongly, so this is really moving towards like a sell signal, because now we have the 20 already below the 200, and the 50 is now starting to move over. And this would then mean that the EMAs are flipped negative. So it means that we have a strong downward momentum. And likely, had we not had that bullish day yesterday, we probably would have already seen a sell signal we would have seen the death cross. Now, let's look at the other sectors, and these are more the value sectors. So XLP, which is consumer staples, you see that the EMAs are all stacked positive. So this is essentially like we've basically been in a positive golden cross. So I don't even know how far we would have to look back to see, the 50 period moving average cross up over the 200, because even if we go down to the weekly chart, you can see that XLP has just consistently been in a very healthy upward trajectory. So then we can go to XLE. Let's go to the daily. Also great chart. I mean, we've had this really healthy pullback to the 20 EMA, and that's honestly a great signal. If we were looking at the Bollinger Bands, it means we're back at the center. While all this upward movement, we were kind of like at that upper 2 standard deviation boundary. This is a really healthy pullback. This is actually a buy signal. So XLP was a buy signal, XLP and XLE. Now XLF, let's see how that is going. And so this is not giving us as strong, a positive. This is like if we hadn't had this bullish day today, we might have actually seen the 20 below the 50. That would have been a neutral signal. But as long as the 20 is still over the 50, over the 200, positively stacked, this is still potentially a buy signal for those who would want to hold this longer term. And XLI, industrials, is also stacked positive, but this could have actually been, again, turned neutral if we would have had that 20 come below the 50. So both XLF and XLI are really like on the cusp. If today ends up being another red candle day or a bearish day, or even a consolidation day, we might actually see XLF and XLI turn from buy to neutral. And XLB, materials, we're still in a quote unquote buy because we haven't had that flip. But I think if XLB, again, if we just have like, if we hadn't had yesterday's bullish action, we probably would have seen all of these in neutral, because as you can see, the 20 and the 50 EMA are starting to get really close together, except on XLP and XLE. Now let's look at XLRE for real estate. And here again, that was, about to have this crossover, but yesterday's bullish activity spared it. And so that is really heading towards a more neutral, but quote unquote, it's still in a buy. Utilities, that's, a super strong value area and clear, clearly value area, not totally risk off. And here you see all three of the EMAs stacked positively still. So yeah, so this is like how you want to evaluate how the market is doing. You would want, if we were seeing indicators, like if we looked back even around towards the end of last year, the EMAs were all stacked positive. So we were getting like bullish signals on multiple sectors. Right now, we are just not seeing that. Now, we also talked about the VIX 3-month over divided by the VIX 1-month chart. And we were trying to see, if that's going to give us some more bearishness or bullishness. So yesterday it actually opened in such a way that, so it opened up at the 1, and the 1 is kind of like neutral. It means, there's like this equal stacking of calls to puts, but the normal ratio is much higher. Like the normal ratio is more towards this 1.20 and higher. That's really where you're not getting this consolidation or distribution, but you're actually getting an accumulation, which is a bullish signal, because it means that there is less supply in the market than there is demand, because people want to buy what is available. Right now, we have a lot of supply in the market and no demand for it. So this is a problem. As you can see, now we've dropped to the 0.90. And if you go back and evaluate the SPX at this time, let's actually compare it to the SPX. You will see that at these periods where we've had really strong, really heavy like selling action, that is where we started to see some bottoms. But here's the thing, we hit this 92, and when we hit it, we got a strong bullish reversal. But here we entered that 0.1 area and we dropped down to the 92. So we actually printed a bearish candle yesterday. This is a bullish candle, obviously, because we opened and then closed much higher. So that's not really helping us. This might actually be a clearer signal, because this is actually a strongly bearish candle. But then immediately we're printing these green candles, and we closed closer to the 1, which is still on the neutral side. We have not closed with a red candle below the 0.92 for a very significant amount of time. And really, we can see that back here around the coronavirus period. And we printed just below the 0.92 in this first candle as we entered the coronavirus period. And then the other time that we really see the below 92 area is back in August of 2019, and then back here in August of 2018. So we are not really seeing that positive January action. This is actually like one of the worst Januaries in the market for some years now. So, these are how you can be using these signals to develop your thesis about what's happening with the underlyings that you are trying to get into. If you are trying to set up bullish, like bullish strategies, like a call debit spread or a put credit spread or buying long calls or selling cash secured puts, then you really need to have the triangulation that we talk about, where the index, the sector, and the underlying you're looking at are all facing bullish. Right now, we are not getting that sentiment from the overall market. And so you just have to be aware not to get faked out by these kind of pump and dumps where a lot of hedge funds or institutions may have had, want to get out of some of their hedging positions because they're kind of losing too quickly. So they're selling, some of their short position or closing some of their short positions or closing some of their long positions that aren't performing. And so this can actually cause a lot of movement in volume, as we saw in yesterday's quote unquote end of day volume pump. But that does not necessarily mean that there is a broad health in the market for a bullish reversal. This does not, looking at this sentiment overall, I am not seeing that we are ready for a reversal, but we are heading towards, I think that we're starting to head towards that bottom. How soon? I think that the whole market is kind of holding its breath until the FOMC tomorrow. But yeah, be careful how you're setting yourself up. For those who are involved in dollar cost averaging schemes or a DRIP, a dividend reinvestment scheme, then, you're starting to see a lot of your favorites go on sale. This might not be the bottom, but, now things are really at great prices and they're much closer to what the market would consider a fair value price in order to start a new quote unquote auction season, where we would start auctioning prices higher and higher as we start squeezing demand. But now there's a lot of supply in the market. Let's see if prices continue to press down, which I think they likely will. So for those who are doing options trading, this might be a good environment for selling things like covered calls. Even with long puts, a lot of people are having difficulty getting the strong outcomes because of the fact that there is a lot of whipping around in the price. So the price isn't just dropping, it's kind of, printing a lot of bear flags or even like head and shoulders patterns, which are eventually then failing. But it's not giving them that full like one directional drop, which is making it difficult for their long prints to be as profitable. But with selling credit spreads and getting that directional move away from you, you would be able to basically day trade your credit spreads with this kind of downward momentum because of the shift of the deltas away from you. So I hope that helps. I hope that gives you some more insight into how you can trade these markets. If you have any questions, get into the Telegram, ask us, ask any of your questions. That's the only way I'll be able to provide you more or better or more precise information about how to trade these markets. All right. Have a wonderful day, friends. Bye for now.